Hello and welcome. You're watching The Investing Edge. I'm Sumaira Abidi, and today we're going to talk about one of the pillars of wealth management, and that is estate planning. Well, you have earned, you have saved, you have invested, you have created wealth, and now you want to ensure the smooth succession to the next generation in your lifetime. So how do you do that? How crucial it is that you do it well? Joining in to answer all of those queries, as always, we have Feroze Azeez, Deputy CEO of Anand Rathi Wealth Management. And also joining in today, we have Mr. Avinash Gupta, who's an investor now for the last decade. Gentlemen, thanks very much for being with us. And Feroze, the first question to you, a lot of people believe that a will is important, but not a lot of people have heard of estate planning. So exactly what is the difference and how important it is that people look at estate planning more holistically, and especially for HNI investors, what are the advantages?
See, I think you have several questions in that one question, Sumaira. I'll try to answer a few of them. So one is estate planning is a process of trying to plan the absence of yours once you're no more. And will is actually a vehicle which helps to achieve that objective. So estate planning is about planning for the distribution of assets which you've accumulated over your lifetime to the people you nominate for this wealth or assets to be transmitted. Will is the most popular vehicle. May not be the most effective vehicle, but definitely by far the most popular vehicle for this transmission to happen from one generation to another, or from a person to spouse or any other nominee.
Okay, but Feroze, it's interesting that it's a part of wealth management. I would have thought that this is something that the family lawyer would do.
Sumaira, I think estate planning is surely an integral part of wealth management. Because no management is over unless you tie all the loose ends together. When you're managing money, you sometimes or most often than not realize that you might have wealth which you will not consume in a lifetime. So if you have more wealth than you can consume in the years you're going to live, then it automatically has to be transmitted to the next generation. So it's a process of wealth management, because every investment you make, even a product is going to ask you for whom you nominate for it to be transferred to in case of your absence. So wealth management definitely is a larger umbrella which encompasses estate planning because that's the ultimate transmission plan. So it's not just about growing your money, it's about protecting your money and also transmitting it over generations. And you know that several HNI families, if when estate planning is not done and ineffectively done, you see huge losses due to this transmission.
Yeah, there are any number of Bollywood and Hollywood movies that will stand testimony to the fact that there are issues if it isn't executed well, right? Mr. Gupta, congratulations on having chosen to do your estate planning. How has your experience been?
Yeah, so for estate planning, as Feroze said very correctly, that once in the absence of a person, if it is not done properly, then there will be a chance of a legal battle, and with multiple agencies, it causes a huge loss of wealth. Some say on an average 33% of the wealth goes waste because of the legal battle. Number two, the successors sometimes do not know where the money is. In that case, it evaporates. Third, the successor does not have time. They don't go after it and then loses the money. So this is my experience with the estate planning. If not done properly, it will be a great loss.
Okay, so you have actually chosen to, be front foot forward in ensuring that there are no hassles. Okay, Feroze, which is the best way to do this? Now, if someone were to come to you and say that, I have this estate, I'd like a smooth succession plan, what would be the first 2 or 3 things that you'd recommend?
Sumaira, I think if somebody has to pursue an objective of having a very well laid out estate plan, he needs to use two vehicles. One of them is a privately managed family-owned trust with beneficiaries who are relatives is the first vehicle which will be needed. And the second vehicle which will be needed is a will as well to complement the trust. Because a person will have some assets left behind in his or her name or on the last day or when he leaves. So a will and a trust together can create a very robust estate plan, which will have to ensure that there is no conflict in the family, there is easy and quick transmission, there is ring fencing as well in this vehicle. So these are the two things which one needs to do. Apart from doing this, the person needs to also take care of the nominations he or she has done in the several instruments the person would have bought in the investing journey to make sure there is synchronization between the estate plan and the actions taken thus far.
Feroze, is this a chargeable service? I mean, would you, do estate planning for somebody who doesn't use your services for wealth management, or is this something that wealth management firms offer only to their own clients?
We don't charge for this process. Of course, it costs Anand Rathi as a private wealth outfit to provide this service, because you will have to have certain degree of expertise and a large team to be able to deliver this to a satisfaction, because you don't want to be making mistakes. But we don't charge for that activity because there's another parallel activity where we have our profitability taken care of. This becomes a collateral service, not paid for, but a very important service. There are seldom investors who take all the services from you and make sure that you're not left with any income on any verticals of your business. To answer your pointed question, at Anand Rathi Private Wealth, we don't charge for it, so that doesn't become an impediment for a person to take a few steps in the direction of making this happen. If I said I'm going to charge a few lakhs to get this activity done, already there is enough inertia in an investor's mind to think of death. This will definitely put it in the back burner, so we don't charge, because we want to catalyze this activity rather than demotivate people to finish it sooner than later.
Okay, so it's one amongst the bouquet of services that you're offering to your clients. That's fair. What is the proportion of people who make these trusts? Is it a very cumbersome process? How much does it cost? And could anybody make it?
See, creating a trust is a very simple process. You can make it as complex as you wish to, or you can make it as simple as you choose to make it. So what we recommend is a very, very simple private trust with limited objective. A person is not creating a trust to hold businesses. There are businesses which get held in the form of a trust. There could be charitable trust. There could be business owning trust. Here we are speaking of a limited purpose to be achieved. One is transmission of wealth. The other is to ring fence the wealth or a portion of one's wealth from all the risks he or she takes when he or she makes signatures. Every time you make a signature, there is a potential liability because of your role of responsibility you would be discharging in a company as a director, or it could be of any such nature. So to answer your pointed question, Sumaira, this trust is a very simple trust which I'm speaking of. Like, I have a trust for myself, where my child and my wife are the beneficiaries. I am the managing trustee, and I'm also the person who created it, who is also in a technical nomenclature called the settler. So you have a settler, you have a managing trustee, and you have beneficiaries who are limited to your close family. And it's a 7-8 page document. There could be trust deeds which could run into hundreds of pages, or there could be as simple, which is a limited time period. My trust is a 20-year trust, or my life, whichever is sooner. And you have small constituents, which are all family members. So it's simple, but it's made simple. It can be made as complex as you chose to.
Okay, so basically the money that has to be inherited by the next generation or next of kin goes into the trust, and the money or the wealth which is for the consumption purposes of the person who's creating that trust, or the settler as you call it, would go into active wealth management. Am I right?
Yes, both will be managed, but a person, when he or she is clear that this is the wealth I'm going to be transmitting, that is best transmitted through a trust. Because there's no time lag. A will can take a few years to get a probate. And the different geographies of the country itself have different rules and regulations. And the nitty-gritty will definitely have some slip-ups, however meticulously you try and do it. So trust lives with you. It lives along with you for years till you die. A will is born the day you're dead. So there is a large merit of having a trust.
Mr. Gupta, is trust the option that you chose as well? How has been your first-hand experience?
Yeah, as Feroze explained, this idea of trust and keeping it very simple is a fantastic idea. I would love to form the trust, and as he mentioned that around the geography there are different rules and regulations, so it will definitely help the person to succeed all the assets that he has in the form of gold or in the form of property or in the form of mutual fund. So all will be entrusted into one thing, and this is a fantastic innovation. I believe that no lawyer would like to suggest it, as Feroze has explained it, that it's a very simple idea and it's very doable. So I will definitely go for it.
All right, good to know that, Mr. Gupta. We'll take a very quick break. So we've heard about the good part of estate planning. Is there a bad part to it? What is the way in which things can go bad, how to avoid it? All of that is lined up next. Stay tuned. Welcome back. You're watching The Investing Edge. With us, we have Feroze Azeez, Deputy CEO of Anand Rathi Private Wealth Management, and Mr. Avinash Gupta, an investor of over 10 years. So we've spoken a bit about estate planning, but Feroze, for every well-executed estate plan, I'm sure there are just as many badly executed ones, right? So can you tell us about, some of the examples in which things have gone bad and how to rectify it? I mean, what should people be wary of?
Yes, Sumaira, there's a lot to learn from the bad estate planning done, so that you know what is the checklist you will have to tick to make sure that you're not repeating the mistakes somebody else has done. For example, if you look at the common mistakes, is non-synchronization of nominees and your will. Point one. So in your will, you might have chosen a specific way, or you have written your desires in a specific way, but your mutual fund investors, for example, might have expressed their nominees differently. Point one. The other thing is, the second one is, quite a few assets get missed in the will because assets keep changing shape and sizes over periods of time. A will which is 5 years old might not be updated with your current balance sheet. So people don't update it as frequently as it should be. So that leaves some degree of heartburn amongst the constituents or the beneficiaries of the will. Third is ambiguous language in a will leaves a lot of clarity to be desired. So that's one thing which happens. The fourth is, I think, apart from the will, what people end up doing is not just people give assets to their kin, but forget to train them to manage those assets. I have seen people giving land parcels in some part of North India to a person, to a child who is a US NRI. And he has no clue of getting to that rural area, trying to liquidate those assets if he so chose to, or manage it. So it's not just about giving the assets to the next generation or your spouse, but giving the capability to manage it gets missed out. In fact, people miss out several things. They don't even write down the list of people who need to be contacted for each specific item. And then, after a few weeks of the person having left this world, the family gathers their thought emotionally and then tries to pick up pieces. So these are the few things which are done incorrectly by several HNIs, to my surprise, not retail investors only.
Mr. Gupta, enough about estate planning. Why don't you tell us about your investment journey? Because you've been an investor now for a decade. What has been the best investment that you might have made, and which is the regret that you have regarding your investments?
Sumaira, first thing is positive side. So positive side is that there are many asset allocation that I have done, but one thing, equity structure, which I have done, it protects your downside. That is the most, in this case of COVID, most of the people have sleepless nights when the index goes down to 8,000, 7,500 kind of. But I was protected by at least 20% downside in the equity structure funds. And when in case of upside, there is a 2 to 3% upside, but I will be able to earn 12, 13, 14% kind of return when there is a equity structure. And when there is a debt structure also, both the upside is good enough, and especially I have a feeling that the downside, the negative side is protected, and it helps HNIs or people like me to sleep well. Second is equity mutual funds. That is okay. That we are doing for last 10 years, no problem. And in case of a negative side, so I fear a lot, and I have lost a lot on the direct stock. When I purchase from the secondary market, the direct stock, our knowledge is very limited. We are not business analysts. We just go by the tips. We just go by the reading on the internet or in the newspaper. So we are not able to capture the entire 360 degree of the company. We do not understand the business. This way, most of the cases, we lost money. We purchased in high, and market really is up and down and risky. This way goes very, very up and suddenly goes very down. So I never recommend the direct stock.
Right. That's good to know. Also, Mr. Gupta, I believe you have a question for Feroze, sir.
The sovereign gold bonds, they are in the secondary market. It is cheaper by 5 to 6% than the normal gold price by the Indian Bullion Jeweller Association. So is it advisable to invest in this high, as the gold is on the top of the world? Everybody is running after gold. So this sovereign gold bond funds, do you recommend?
See, there are two parts to it, Avinash sir. One is how good is gold as an asset in Indian rupee, and is the best vehicle sovereign gold bond. My answer to the second part of the question, if you have to invest in gold, to my mind, the sovereign gold bond is the best vehicle if you have chosen your asset, which is gold. Because it gives you immense amount of tax benefit if held till maturity. You get zero capital gain tax at maturity. That's a very big advantage, can give you an uplift of 2-3% a year. Assuming 20% taxation is what gets charged on other alternatives, point one. Point two, it gives you a recurring 2.5% interest on a 6-monthly basis per annum, so 1.25% every 6 months. So these are big arbitrage opportunities which you would not want to miss once you've chosen gold as an asset class. But where gold is today, because of the fear across the globe and the kind of money supply each of these central banks have pumped in, so gold has had some recent rally, not some, a lot of upsurge in the prices. Of course, close to 40-50% in the last 1 year. So you'll have to be cautious. It's not going to be a one-way rally. Once fears die down, once liquidity comes down in the marketplace from the central banks, gold will see its place at some more sensible levels than the elevated ones which we currently see at.
All right. Thanks very much for that, Mr. Gupta. Feroze, thanks always for joining in. With that, we'll wrap up then on the investing edge. But as we do that, we'll leave you with some very interesting mutual fund analysis coming in from Rishikesh Palve, who's the head of financial strategy at Anand Rathi Private Wealth Management. Thanks for watching.
Thank you for the wonderful introduction, Sumaira, and thank you to have me on the show. Today we are going to talk about Aditya Birla Sun Life's Frontline Equity Scheme. Anand Rathi rating for this scheme is 2-star out of 5. And the call that we are giving is a sell call. I'll take you through the reasons why am I saying so. We'll look at the qualitative as well as quantitative parameters. So this fund is an open-ended diversified equity scheme, which predominantly invests into large cap stocks. As per SEBI categorization, this falls in the large cap category, which comes to say that minimum 80% has to be invested in large cap stocks. This fund was launched in August 2002. And as of end of July, the assets under management of this fund stands at 17,480 crores. Now let's talk about the fund manager. The fund manager of this fund is Mr. Mahesh Patil, who also happens to be the co-CIO of Aditya Birla Sun Life AMC. He comes with over 27 years of experience in the fund management space, and he follows the blend strategy, which is a combination of growth and value stocks. Now, talking about the portfolio is well diversified across 61 stocks and has exposure to 10 to 11 sectors. 97% of the portfolio has equity, 2% is in cash equivalents, and 1% is in debt. Of the equity portion, 86% is in large cap as per the regulatory requirements, and the remaining 40% is in mid and small cap. Let's talk about the quantitative parameters. When we evaluated this fund by Anand Rathi ranking methodology, where we use historical as well as futuristic parameters. Parameters like return potential, parameter like consistency of the return, consistency of alpha, risk, which is measured by standard deviation, capability of fund manager to pick the right stock, to name a few. So the fund scored low as against its peers on certain parameters, which is return, risk, which is calculated by standard deviation, and the capability of fund manager to pick the right stock, which is calculated with the help of a stray ratio. And the fund has scored decently on parameters like valuation and consistency of alpha, which is calculated by the standard deviation of alpha. And that is the reason we have given a score of 2-star on 5. So from the performance standpoint, if we look at the 3-year annualized rolling returns, the fund has given a return of negative 1.33%. The category average for the same time is 1.27%, whereas Nifty at the same time has given a return of 2.49%. So it comes to say that the fund has not performed as well as its category average has. Now let's talk about the risk. The risk is measured with the help of 3-year standard deviation. When I look at the 3-year standard deviation of the fund, it comes to 20.8%. Wherein the category average is 19.8% and Nifty at the same time is 21.25%. Because the standard deviation of the fund is higher than its category average, it becomes riskier, more risky than the category of its peers. From the valuation perspective, like I said, it looks better because it is cheaper and it is attractive as against its peers. And this is calculated with the help of PE and the PEG ratio. And the attribution of that goes majorly to the blend strategy that the fund manager follows, which is a combination of value and growth stocks. Now let's see how the performance of the fund for the last 3 years, how it would have performed. If an investor would have invested in this fund 3 years back, he would have made an annualized return of 0.93%, which comes to say that 1 lakh invested 3 years back would have become 1,03,000 today. If he would have invested in Nifty, he would have made a return of 4.5%, annualized return of 4.5%. That comes to say that a lakh would have become 1,13,000 in the last 3 years. So this is in a nutshell about the fund, and this is our evaluation of the fund. Thank you so much.